The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalised advice tailored to your specific situation.
We listen to feedback as a business. It's one of the things you talk about sport that I love was feedback, because it's not personal, right? Like I love feedback, positive or negative, because we're working towards an objective, right? And when I was swimming and my coach was yelling at me, it was because he wanted to make me better so I could win. So it wasn't a personal thing. It wasn't because he didn't like me. And it's the same with our business as well. So we listen to a lot of feedback from the market. And one of the things we got from advisors is this is a great estate planning tool because you have binding nominations. So therefore, you have absolute certainty it's going to go to that individual or that beneficiary because it bypasses your estate or your will.
Hello, everybody, and welcome to another episode of The Wealth Guide, sponsored by Ryker Capital. My name is Tamara, and I am the practice manager. Really excited today. We're talking about tax. Well, that's not exciting, but not paying more tax than we need to pay. Everybody's very, very conscious of that and making sure that they're investing in, I guess, a tax effective or tax efficient way. So to kind of drill into that a little bit, specifically, we're going to talk about something called an investment bond. Some people know about it. A lot of people don't. And we're really excited today because we have an expert on this topic today, our very special guest, who is an Olympian, an Olympic medal winner swimming for Australia, and now is the CEO of Generation Life. Welcome, Mr. Grant Hackett.
So thanks very much for having me.
Very excited to have you here. You probably picked up the accent. When I first moved here from Canada, which was quite a little while ago, I was cheering for you madly. I was so excited to be part of this country and such an exciting swim team. So that's how I got to know you when I first moved here, which is really great. There you go.
I always like the Canadian swim team, so it works. We're big supporters of each other, as long as we're beating the US.
I hear you on that, but let's not get too controversial at the start, Grant. Also joining me today on the sofa, I have two senior financial advisors with Ryker Capital. Gentlemen, would you mind introducing yourselves?
Thank you, Tamara. G'day, guys. My name is Ray, a director and founder of Ryker Capital. Super excited to have Grant here. So a little bit nervous at the same time. But,
he said he's going to put us at ease because he's used to doing this kind of stuff.
And hi guys. My name is Dean Dasuki, also a senior financial planner here at Ryker Capital. And
And away we go. Look, before we go into the topic, if you don't mind, Grant, now that I have you here, I didn't actually realize that you had gone into the finance industry till about, I think it was probably about 6 years ago. I went to a workshop or a seminar that Generation Life did, and you were presenting. And I went, Grant Hackett's presenting at this, and you were amazing, which was really good. But I mean, maybe for our listeners, like, how did you go from swimming to where you are right now? I don't think it was accidental. I think you were interested in this for a long time, right?
Yeah, definitely. I've been interested in finance ever since I was a young kid, to be honest. Like, even as I started earning money in swimming through my teens, I wanted to trade shares and invest. And it's just been an area of interest for me. As soon as I finished high school, I was studying commerce law at university. I did my MBA after my swimming career. And, so I was always doing, I guess, educational things to be able to further myself for beyond the pool. But it is funny. I often get, when I'm at events or talking, or they see a CEO of a listed firm, people start to tilt their head at you going, is that the same guy or not? Because I know him in a pair of bathers, not a suit.
I almost didn't recognize him in the suit.
You just put a cap and a pair of goggles on and I know who you are. So it is interesting for people. But the funny thing is, I've actually been in finance longer than I was a professional athlete for. I was a professional athlete for 13 years, but I've been doing this for about 16 years now. So this has kind of taken that over well and truly, but not quite as high profile.
No, for sure. Is there anything that kind of transferred, like the things that you learned or focused on, or really were used to drive yourself from swimming to what you're doing now in your current role?
Yeah, a lot of those basic principles of high performance or success are very much the same in any sort of environment. So, whilst I was finding my feet at first, because what's really interesting, you almost go from being the global CEO in what you're doing, all of a sudden to, I started at Westpac BT, and you go in on a Monday morning on Collins Street and you're not the best at the table. So it's a very humbling experience. And then as I kind of worked through that, developed the skill set, got to understand those businesses, how to drive them. I've always loved people leadership. I love seeing people do well. So I've always gravitated towards those sorts of positions of management, and even being, captain on the Olympic and swimming team. I think for me, that was kind of a natural progression, but certainly those principles of driving performance in teams and having discipline around it, having what I call a really strong operating rhythm in terms of the way you check in with your people, keep people accountable to their tasks, but also have a reward and recognition system in place, which is really, really important for, people to get recognized for the goals that they're achieving as a business. But one of the most interesting things that I really brought across from sport to business was more clarity. I find in business there can be a lack of clarity. Sometimes you can have too many metrics and you kind of can get confused and lost at what is it we're actually trying to achieve. So I almost try and oversimplify everything in our business just to make it really clear that, if you're in the distribution team, you can calculate your bonus in the minute of the day to how you're tracking year to date. And you're going to get paid that because it's a big integrity issue that, regardless of how the overall business is performing, if you perform well, you'll get that reward. So those are the sorts of things, and there's many other attributes that I've obviously been able to take across. But in simple terms, clarity is probably the most important thing.
That's a really good segue because of course we have advisors in the room as well. And so we're doing, B2C. So we're dealing with clients. And it's really that clarity and being really clear and making sure that we're speaking in non-technical terms and checking in to make sure, are we being clear? Did you actually understand what I was trying to tell you?
It's a different language, finance, right? Like
Absolutely.
Once you start talking, you can talk in acronyms and you can default into things, but really simple speak. Like, don't try and sound like you're smart. Pretend you're actually talking to a 3-year-old, because that's almost how much you've got to dumb it down sometimes, because it is really complex and really intimidating stuff for a lot of people. And you don't want to intimidate them so much that they actually avoid putting off meeting with a financial advisor or actually proceeding with something, because that can be the worst outcome for the client and obviously, the practice that's dealing with them.
Correct.
Well, I'm the perfect facilitator for this because I do not have that technical background. So, and that's a good segue too. So we might talk about the investment bond and break it down. So as we were kind of talking about earlier, we have Grant for 2 episodes. So really, really excited. We're going to talk about really unpacking what is this investment bond, and then how did we kind of use it in an investment way for, younger people and families in the first episode. So when I hear investment bond, I just hear bond. Grant, is it a bond? What is an investment bond?
So the reason that has the word bond is because it's a insurance-linked product. So it's an investment-linked life policy, and that's why that technical term is investment bond. So you're investing in something, your chosen investment, and it's a bond under those sorts of terms around the Life Act. So, but it's not a fixed interest product. That's not what it is, because people go bond. I think of corporate bonds.
That's what I thought of.
Government bonds, all those sorts of things. So it's very easy to make that mistake. The easiest way I explain an investment bond is it's just another legal structure to invest through. It's actually not a product technically. It's a structure to go through, like a trust structure, like a company structure, like you as an individual, you're a legal structure as well. And with that legal structure becomes a different set of rules. And what I liken it to is superannuation, in the sense that it's an after-tax paying structure.
Correct.
And there's obviously, depending on your own personal tax situation and what you're trying to deliver in terms of outcome for that, is that you invest through this legal structure, has a maximum tax rate of 30%. So if you're on a high marginal tax rate, it's obviously better. Our effective tax rates, because the way the tax rules work, often sit between an average of 12 to 15%. So it's very, very tax efficient. And at the end of the day, in terms of your investment, you can choose anything from, cash and fixed interest and bonds and all those sorts of things, all the way up to high growth products. So we have 69 different investment options on there. So it really suits, anyone who wants to be, blended in the diversified space to any sort of risk profile across those asset classes. So it's, when you think of an investment bond, don't think of a product, think, okay, this is a legal structure for me to invest through. and does it suit my own personal needs?
It's so funny you say that, Grant, because most of the people have got a very negative connotation of the investment bond.
Yeah.
They go back to the old days of thinking
Correct.
how it was invested. So most people sort of try to stay away from it.
Yep.
And that's what I'm going to sort of clarify a little bit, that it is not like that.
No.
It is such a good investment structure where you've got the estate planning, you've got the tax structures, all these little goodies that are in there that you can take advantage of.
Yeah.
And you can sort of make it changes as you like to, as it suits your personal needs.
Yeah.
So you can ever be so evolving in that nature.
It's so true, and it's a really good point, because a lot of these products back in the 80s, I'll call it, is that often a life company had the structure to invest through. The commissions were really, really high, so that's kind of scary stuff. The second part, they were all the investment products, the underlying products were issued by the life company, and they were all these capital protected products. So really, really low returns, really high margins. So really, who cares about any tax efficiency there?
Well, it just literally got written off really by the fees that were taken out.
Yeah, correct. So you're not actually getting ahead too much in that type of space back, sort of 30 or 40 years ago. Fast forward to today, it's a very, very different structure, and we've innovated a lot in the space. So, we have a tiered pricing structure, so it's very, very cost effective. Often a lot of our clients' average overall fee can be around 40 basis points, which is obviously really cost effective. Yeah, and then you kind of look at and you don't have a platform fee on top of that, because it doesn't sit on platform. We kind of run it ourselves and do all the data feeds back to all the individual practices. So that's one aspect to it. The second part is we're investment agnostic. We don't issue our own investments. We actually work with all the big fund managers, or we develop products with them. Yeah. So you get that choice now, where you're not just being held to, you've got these 5 investment products. We have 69 options, like I said, on there. And as there's more demand, and they've got good research ratings around them, we will add more products to that investment menu. And we also do a lot of analysis to make sure that it's a highly tax efficient option. Yeah. Because the way that investments are managed, it's really, really critical for us to consider that. Because as you can imagine, 10% returns can be very, very different. Correct. Is it capital growth? How much is realized? How much is unrealized on the gain? How much is actually income produced in that? So that can all really affect your after-tax position, which is what we're really about as a firm, because a lot of people look at headline returns and you might think, 10% is great. But what does it look like after you've paid tax on it? Correct. Because that's your biggest expense on any investment. And that's the one piece around our value proposition we're really conscious on managing on, is creating that after-tax performance at a really, really high level. And that's been great in terms of some of the outcomes that we're delivering now for clients. And now what we do is we do what we call tax optimized reporting, where we compare it to other structures. So you on 47%, you on 39%, or a bucket company at 30%. Right. So you can actually see the tax arbitrage. So we found ourselves in this situation where there might be a headline return of 11%. We look like 9%, which is actually a really good after-tax performance. But people go, I like the 11. Yeah. And it's like, you don't get to keep the 11.
You got to pay tax on that.
Correct. And then when you compare it to the other tax structures, if you went into the same asset and you see, that one would have been a 7.5, that one might have been a 6.8, and that one might have been a 6.7. I really like 9 now. So these are all the things that we're trying to make it more easier to understand what the performance looks like moving forward around investment bonds. But it's changed a lot.
I absolutely love it. I think, compare that to superannuation structure.
Well, and the thing with super, because we're talking about young people in this episode too, because we do get sometimes, and correct me if I'm wrong, I think, Dean, because I know you work with a lot of younger clients as well. It's kind of like talking to my accountant and thinking maybe I should do some salary sacrifice into super, and they're like 30 years old. And then it's like, well, you get the tax deduction, but you can't actually do anything with the money till you're like, even older than I am. Yeah. So, I mean, that's kind of one of the shortcomings with super.
Absolutely. Yeah. When we sort of sit down and talk to clients or advisors, we understand that no one structure is the silver bullet, right? It's a combination of each of these. So, if you are 30 and, of course, you've got to think about your retirement, but you're still 30 years away from preservation age. Yep. So, and being able to access those funds. Yep. What happens if you want to transition to retirement in your early 50s and you want to do that tax efficiently? And so we always say a lot of these strategies, when it comes to super, when it comes to, other investments that you might have, that the investment bond runs in parallel with a lot of this to be able to give you more flexibility and produce outcomes that you're looking for tax efficiently. So why salary sacrifice is a great way and a very tax efficient way to do things. There's certainly other things to be able to produce different objectives that you might be looking at through your investment life, because super's not the only one. And I guess the other thing with superannuation now, that there's a little bit of hesitancy because there has been so many changes inside super, and it's such a big pot of money for the federal government, who's obviously got deficits that they have to consider, that, you tweak with that pool of money, it can change it quite materially. And we've seen preservation age go out from, of course, 55 to 60 now, if you're a 30-year-old now, will it be 60 by the time you get there, or will you push it out further? So it's not saying that super's bad. I certainly don't think that. It's a great structure, and it's been fantastic for this country around retirement. But I think you also have to consider other things that you've got more liquidity around that are still very tax efficient for you as well.
So funny you say that, because I think so many people are frustrated by some of the legislative changes that's consistently happening around superannuation, because they're trying to plan out for the future and they just can't, because you've got constantly moving goalposts that's happening from the government side. So I think that adds a great value. I'm like, to the recent example of a client that I sort of looked after, he's already maxed out his contribution caps. So for him, it's a lot easier to now have that as an investment bond, where he adds continuously to it, to the 125% rule. And it works perfectly for him, because from the after-tax money, he's consistently investing that spare cash going in there to the tune of $50,000 every year. So
we see a lot of clients like that are capped out in superannuation. Well, to be honest, it's the reason that I actually came into the investment bond space, because back in 2017, we saw those caps in super and the concessional, non-concessional caps. And we thought, well, this is the most tax-effective structure outside of super, and it's the most flexible investment structure, full stop. So we thought, well, there's got to be a flight here, but we've got to re-educate the market on this new era of investment bonds. So 100%. That was, a lot of pounding the pavement, and, we've kind of gone from doing, around $100 million of inflows per year to well over $500 million per year now of inflows, and managing sort of billions, in terms of inside our structure now. So it has grown materially, but really, this latest round of obvious changes in superannuation with the double taxation and taxing on unrealized, realized gains as well, for amounts above 3 million. Obviously there's, more business for us to do there, but it's not even so much people that have necessarily gone through that threshold. It's people going, well, I don't really want to necessarily put all my eggs in one basket now. So I've got to diversify that out a little bit more, use different structures for different purposes, just so I know I've got, liquidity, but I'm still saving, highly tax effective super is. We certainly think, that's not going to change in terms of it for those lower balances, but it's also making sure that we talk about bracket creep, right? And for those of you, the listeners who don't know bracket creep, that's you just moving up to the next, tax scale. So
our listeners know about bracket creep, because we get that. I'm paying too much tax. I'm making more money, but I'm paying more tax.
Correct. And that's a really hard thing, right? And you sort of start investing money, and if you're investing in your own name, all of a sudden you get investment income, and then that adds to, the fact you've been promoted, or you're making more income, or you got a bigger bonus that year. Then all of a sudden you're paying a significant amount more tax. When you're in the investment bond structure, you're not adding to that income. You're still generating it, it's still yours, but it's it's at a much lower tax rate, and it's not pushing you into the next marginal tax bracket.
I might drill into a couple of those things, just for people who are listening who I know might not be up to kind of the concepts you're talking about. So just a couple of things with regards to tax returns. When you said it's not adding to your tax, so I'm not actually like, if I invest in an ETF in my own name, whether I sell it or not, I probably have to, I have to disclose, or I have to add it to my tax, any returns I have. So that's not what I'm doing if I'm investing in an investment bond. Is that what you told me?
Correct. Yeah. The big difference is obviously investing through your own name. Every time you're generating income off that particular investment, every time you get a distribution, which you can't control from that investment, obviously you've got to declare that to the ATO, and obviously that's going to add to your taxable income. So, and depending on what your circumstances are, that can obviously push you up into a higher tax bracket, which is far from ideal. Compare that to the investment bond structure. It is isolated into that structure. So that's it. So say you're at $180,000 of income, you've got another $20,000 of income or growth within your investment bond. It doesn't change 180. It's not added to that. It stays in that structure because it's a tax-paying structure. Also, you don't have the additional fees of being able to manage that growth. So, whilst you've got your normal accountancy fees, we do all the after-tax payment and we do all the accountancy fees and we manage all of that. So you can take a distribution at any point in time. You've got full liquidity. But if you hold it beyond 10 years, and I know I'm getting into something technical here, you can take a full redemption and you don't have anything to declare on your tax.
Tax return.
So it's
But that's only
really
after
powerful.
10 years. Oh, sorry, Grant.
No. I think it's just really powerful that you don't have all these additional fees and management and distributions
Along
that
the
might
way.
be coming through along the way. That's correct.
That to me is almost like if I'm holding it for 10 years or more, and I don't have to because you said it's liquid. Almost those annual non-tax consequences really add up. Almost even more so than capital gains.
They do.
Yeah.
People don't understand how much that stuff just eats away at your return when it's adding to, you've got multiple sources of income and you're obviously diversifying your revenue streams because you're making enough money to invest now, how much that can add up in tax. And also the fact that a fund manager 30 June can distribute a large amount to you that you probably don't want, where you don't have that problem inside the investment bond structure. And even inside 10 years, if you need to access the capital, you can at any point in time. It's completely liquid. But there's a lot of tax efficiencies inside 10 years because obviously you've been paying a lower tax rate along the way. So you've got the benefit of tax deferral because you're getting the compounding effect of that. And also the other aspect too is anytime you take a distribution inside 10 years, even though inside our structure you could be paying one of those average tax rates of 12 to 15%, you always get a full 30% tax offset. That's the rules. So you've actually got a tax arbitrage quite significant inside 10 years.
Especially
After 10 years, you just don't have to worry about any of that. All of that goes away and there's nothing to declare to the ATO. Even if you've grown, $10 million inside your investment, it does not matter.
It's such a good strategy for high income earners.
Well, I think, definitely. I think so. Yep. Yeah. Well, even not terribly high income earners. You know what I mean too, because it's really that actually makes a difference. But certainly for high income earners, it just it's bigger.
I think anyone who's kind of got a little bit of money to invest, to your point, Tamara, just around even if you're, I wouldn't say a low income earner, but you're earning a decent amount of income, but you've only got a small amount of discretionary investment.
Exactly.
It's still really good and tax efficient for that because again, it's not pushing you as you sort of get promoted through your career and earn more money into a new tax bracket. So you've got to have a bit of forward planning around that. Hey, I might be earning $150,000 today, which is a good income. But however, in 5 years' time, I'm probably going to be earning 200 or more. And then I know I'm on the highest marginal tax rate. So you've got to think about how am I setting up my investments, not just for today, but how I look in 5 or 10 or 15 years.
Well, that's what
future planning.
Well, it is. And that's what Dean and I were talking about. Because again, you've got those clients where they're earning pretty good, but they're not in their high income earning years. They are, to your point, Grant, in the next 5 or 10 years, they're going to be in that bracket there. So from what I'm picking up is how you start your investment journey, how you're starting to invest, that structure, ownership, tax. You want to do that kind of at the beginning of actually creating wealth, and that's what you're saying,
absolutely. So one of the big considerations I think for all of us that want to have a family is obviously you might want to send your kids to private schools, particularly if they once they hit high school. A lot of people want to do that. I've got twins that are 14. I didn't set up investment bonds when they were born, and I'm now paying for their school fees just as pay as you go, which is not a lot of fun because there's no deductions around that. However, I've got a 3-year-old and a 12-week-old.
Congratulations.
Thank you very
much. So you're a bit busy then.
Life is full. Life is fun, but it is full. And to be honest, I set up investment bonds for all of them because I don't want to be in that situation again where you're having to pay out of your income to, these expensive school fees where now I know I can set that up. It's really tax effective. And it's funny, my Edward, the 3-year-old, I can see how much it's grown. And I just have a savings plan that automatically gets deducted each month into the investment bond. And I just love it.
Yeah, I wanted to talk about that. I know the technical thing is, because I've heard Dean talk, is dollar cost averaging. I said, what is dollar cost averaging? But I think that's what you're talking about. Can you explain how can people get into this with young kids?
Yeah, so the best way I sort of look at it, and a strategy that's quite common that I see that comes inside our structure is people will put a capital sum in. A lot of the time it's actually a grandparent. So if they have a newborn or a young child, they might put in $40,000 or $50,000 and then the parents might put in a few $100s a month. And it's just direct debit. And it is dollar cost averaging into it because obviously you're investing into those investments at different points in time. So the valuations of, those investments are going to be changing on a daily basis given market volatility or any sort of economic contractions or growth that we might be having. So therefore you're sort of costing it in on a pretty good average over time, where you're not picking the bottom, but you're not picking the top.
It's just regular investing.
Correct. And then so you're getting this sort of, I guess, duality around the compounding effect, right? Because you're regularly putting money into it and you're getting priced at a decent price. And on the other side of that, you're obviously getting the underlying investment growth too that's coming through. So by the time a lot of these kids become teenagers, all of a sudden you're in this tax paid status. You've gone beyond the 10 years. You've been paying tax in a much lower tax environment. And then you don't have to worry about being able to pay for a lot of these fees, or at least all of these fees out of your own pocket at a high marginal tax rate with absolutely no deductions.
But not only that, you can dictate when you want to access that.
You've got control over that,
Correct.
Right.
I even look at it too. So for my younger two children, and I'm setting, ones up also, I've set ones up also for the older kids as well. But I really look at it in two ways. I go, okay, maybe if things are okay, I might still keep paying those private school fees. But a house is really, really expensive, particularly if we're in Sydney or Melbourne markets, but in any market in Australia, because we love property as Australians. So we keep pushing the prices up there, and we've got negative gearing. So there's incentives around, of course, being a property investor. But at the end of the day, if you want to actually see your kids get into their own home, you're probably going to have to give them a bit of support. And you might necessarily want to wait until you pass away, because we're all living much longer these days as well. So you don't want to giving it to where they're in their 50s or 60s. So, you could sort of look at it too as a home deposit, or being able to support them in that sense too.
It's so funny. We get this common example of cases all the time, including grandparents who want to skip a generation and literally pass on the money to their grandkids. So it provides that definitive solution for them to go, I want to leave this money for my grandkids so they can afford to buy a home and could have a deposit in the next 15, 20, 25 years.
Yeah, that's an awesome strategy. I love this strategy, right? And we've actually, and I get really passionate about this because this is not like
you're kicking it up, Grant. I can tell.
Because I don't know, you're producing great outcomes for people, right? And we listen to feedback as a business. It's one of the things you talk about sport that I love was feedback, because it's not personal, right? Like I love feedback, positive or negative, because we're working towards an objective. Right. And when I was swimming and my coach was yelling at me, it was because he wanted to make me better so I could win. So it wasn't a personal thing. It wasn't because he didn't like me. And it's the same with our business as well. So we listen to a lot of feedback from the market. And one of the things we got from advisors is this is a great estate planning tool, because you have binding nominations. So therefore you have absolute certainty it's going to go to that individual or that beneficiary, because it bypasses your estate or your will. So if you've got a situation here where you're talking about grandparents investing for grandchildren, what happens with their kids? What happens if their kids are divorced?
Exactly.
What happens if there's more grandchildren on one side than the other? So they want to leave, a different balance through their estate. So an investment bond is a great way of doing that. And what we've done now is build a thing called a future event transfer facility. So you can determine how and when those funds are transferred. So if you're leaving a large capital lump sum to a 10-year-old, might be $100,000, you don't want them to access it at age 10, because someone else is going to be spending it on their behalf. So you might say, well, they can access that when they're 21 and they can access 10% of the capital amount or a dollar amount. You can do it any which way you want to. And there's no extra fees we charge for that. So it's really operating like a testamentary trust in many senses, but you have this absolute certainty. And then with the rest of the estate, you can do estate equalization to your children that might be there. So you can leave, you might have 7 grandchildren on that side of the family, but one of your kids mightn't have kids and they don't want to leave more to them. And they feel like they're unfairly dealt with just because they didn't have kids. So you can do all these sorts of, I'm not going to call them fancy things, but you can get the absolute best outcome that you're looking for and not fracture the family and make them fight over an estate in the meantime.
That sounds good. I might steer away from that a little bit now. That was great information. We're going to get to that in the next episode, but I wouldn't mind drilling back into maybe getting an example with younger people, like with yourself, with Dean. So some of what you said earlier, Grant, really twigged on me. People who are kind of starting out a little bit more new in their career, we really drill into what is that surplus cash they have that's going to be going towards investing. investing, and then how do we use that really, really well? I think you were talking about an example. You had some clients come to you and they were saving for the education, but they were putting it into a bank account or
and just receiving the normal traditional bank interest, which obviously always fluctuates. There's not much there. And also at the same time as well, the wife was on a pretty decent income as well. So the tax implications behind that. So we like to utilize the bonds because it gives them the flexibility of having that money sitting in there in the investment, and then you've obviously got the tax savings around it as well. So it helps to manage the tax side.
It's quite remarkable. That's a very sensible strategy, right? Like I'm saving, I think I'll put it in a high interest account, and interest rates are a little bit better now, but then you're paying the tax and you're paying it at your marginal tax rate. So, and also, we talk about bracket creep before you're adding to your taxable income. So I think, it's a really sensible strategy to go, hey, I can actually isolate those investments over here. It's not going to add to my income. And at the same time, it's going to be really tax efficient inside that. And of course, you're not going to leave it in a minor's name because they're going to attract a ginormous tax rate that no one wants to pay. That's 2/3 of the income.
But Grant, can we talk a bit more about how the companies can benefit out of this, out of the investment bond structure?
So what we see from a company point of view, we don't recommend that the company actually invest in there because they are similar tax rates. What we see a lot of people do is over time they actually siphon money out from the company and they either invest it through the trust. So a lot of people have a trust structure in place naturally when they've got a company attached to it. And one of the other aspects that we see is that people really like to be able to remove, I guess, the tax liability over time that sits in a bucket company. Because as we know, once you've got money in a company, it's not your money. It's the company's money.
Correct.
So therefore you want to get that out over time. And what we see a lot of people who have trust structures in place that are distributing to a bucket company, that's a great strategy in terms of, tax deferral because it's got a maximum tax rate of 30%. But eventually one day when you actually want that money out, you've got to pay the highest marginal tax rate normally if it's a large amount. And what people don't understand, and this will get a bit technical for a second and do people's heads in, but I'll give an example to bring it to life is when you pay the difference between 30% and 47% when you take that money out of the company, it's not 17% the difference. It's 24.3%. And the reason that is the case is because you've actually got to gross up to what the original earnings were, then you pay your 47% tax. You're not paying the 30% tax and then adding 17 to it. So it's like I say to people, if you've got a fully franked, people understand fully franked means the tax has been paid, fully franked dividend of $100. And then you go, okay, I want to put that in my own name because it's in a company. You don't take off 17% to get to 47%, and then you have $83 in your hand. You actually have to gross it up to the original earnings, which was $142. And then you pay 47% on the $142, which then takes you down to $75.70. And this is the thing when people are trapping too much money in a company, that they're going to have this issue that's going to be growing and growing moving forward. And a lot of other people like to lend from their companies.
Correct.
But you actually have a statutory rate, I think right now is about 8.2%. That then is adding to your liability inside that company. So what we see a lot of people doing now, particularly if they've got trust structures, when they're distributing money out to beneficiaries, and one of those beneficiaries being a corporate entity like a bucket company, is they're actually putting the investment bond inside the trust because it's an internally tax-paid instrument. You don't have to distribute the income from the trust. So you're stopping this issue of money going into it. So we see all sorts of things where people are willing to pay the tax of the bucket company now, then put it in a more tax-effective structure, or people siphon it out over time, or people are distributing to the bucket company, which they try and eliminate or dial down a little bit by putting the bond inside the trust. So there's lots of different strategies, and you can get quite technical on this stuff. And that's why it's really important to have a good financial advisor, because, as much as, we love living in the country that we live in, and we love, the infrastructure that we have here, we don't necessarily want to pay more tax than we have to.
Which is how we opened this conversation. We have people calling and asking us all the time. So it really comes back to then planning, getting the right, if you need that professional support to get it right, and really understanding what your steps are. And even I understood from your explanation how it can be advantageous to have actually that bond as a structure inside of a trust structure. That does make makes sense.
Yeah, any legal entity can actually own an investment bond.
Yes.
So we've seen some super wealthy clients that have utilized the investment bond to be able to leave money to a charity upon their passing. So because
Which can be controversial.
Yeah. Well, most charities don't even contest it these days. If
Right.
the children that, the other beneficiaries are going to fight for that, most of the
They just
charities
go.
will just give up because they know they'll lose. So a lot of the time the bond's great to set up because you can leave that money to that charity and it's going to be left to that charity. So you've got this absolute certainty, which is really nice in terms of leaving a legacy around what you've built throughout your life.
And that's the great part of it, just leaving that as a part of that beneficiary structure in there that allows a certainty for them that the person nominated is going to get the money.
Yeah.
And it's not going to be contested down and bring the estate value down.
And what's really important about this, we know that, super, as much as it's not built as an estate planning vehicle, it is utilized as an estate planning vehicle. And there's often large bequests that are left through super. At the end of the day, if you're a non-dependent and there's a taxable portion in super, you're going to have a tax liability that's there. The other great thing about the investment bond for estate planning purposes is not only do you get that certainty, is that it's tax-free upon death, regardless of who the beneficiary it is, whether it's anything like we just spoke about, whether it's a charity, whether it's a dependent, whether it's a non-dependent, and you set it up last week or 10 years ago, it does not matter. It's 100% tax-free upon death.
That is exciting for sure. How about asset protection? Do bonds are they useful for that kind of thing?
Yeah, if you want to
I don't really understand how that works actually, but I was kind of Googling it and I thought I'll ask that question.
If you want to read section 1162B of the Bankruptcy Act,
I don't.
Then you'll see that they are. So they're actually, they can be set up to be creditor protected. So it's one of the nice things because I know a lot of people don't necessarily like investing through their own name because if they were, subject to creditors or a lawsuit or something like that, of course, people could access the assets that sit there. And that's why people put a lot of their assets inside a trust because you can't sue a trust. So it's really nice that, if you were to go into financial hardship, that the investment bond is creditor protected. So it doesn't matter what the amount is sitting in there. And in fact, if you fall into financial hardship, those things that we've spoken around being tax paid after 10 years, that actually falls away, even if you've only held it, say, for 4 or 5 years.
Right.
And you can start, if you're in financial hardship, you can start receiving a distribution from that investment bond. It's tax paid and it's creditor protected. So you've kind of got these 3 core things I always like to talk about with the investment bond. If you're looking for 1, a tax arbitrage, 2 for estate planning benefits, or 3 for creditor protection, this structure is right for you. So that asset protection is really, really key and really important.
Love it.
Can I ask about, I know the 125% rule.
Yep.
And I know we were talking about that again, coming back with when you're doing strategic planning and you're planning for goals, like you said earlier, and some of them are going to be goals that are not related to retirement. We're trying to squeeze the juice out of people's cash flow and contribute to these bonds. But the 125% rule has to do with there's some kind of rules around how much you can contribute. How does that work, Grant?
Yeah, that's right. So there's probably 2 key aspects before I answer directly that question is 1, you can have as many investment bonds as you like. So if you've got multiple grandchildren, you can set up one for each of them, which is something we normally recommend when we're dealing with advisors. And then the other part is you can have as much in there as you like. So, you're not restricted. There's no caps inside the structure. The third part there, which is the 125% rule, is what that means is you can put in 125% of the previous year's contribution. So if you put in $10,000, obviously the next year you can put in $12,500. Now, the reason that's the case is because you've got this tax paid status at 10 years. So instead of putting $1 in on day 1, then waiting 9.9 years and then putting in $1 million, then being in this tax paid environment, you've kind of made a fair arbitrage within the system there. So what they have is you can just put in either 1% of that 125% or up to 125%. So what we see with a lot of our investment bond holders with our business is they attach a regular savings plan. So they're always utilizing some portion of this. And, I'm a client around that myself for the business.
And you don't want to stuff around with that either, because if you miss that, then you're going to have to start a whole new bond altogether.
Correct. You just leave that bond as be and all those benefits are intact. And, you've got tax-free transfers as well. So if, we're getting along really well and I really like you and I want to transfer my bond over to you. The nice thing about this is you don't have a CG. My kids won't be happy. You don't have a CGT liability that's triggered, and also you don't have stamp duty on the other side. So it's really, this is where I talk about flexibility. It is completely
flexible.
portable. So those sorts of things are really important attributes of the bond. So yeah, if you do forget to do that, you can just set up another investment bond and then start, accruing and building that one too.
I mean, like you literally save so much money in legal fees. If you had to do that with a lawyer or an accountant, you'd be paying thousands of dollars just to sort of get the structure amended to what you want it to be.
Yeah, exactly. And we have flags in our systems when people actually go and, they're going to breach 125%. We say, hey, you're breaching 125%. Do you want to do that or not? So we actually make sure that we make note of all those things for the client. So we make it really easy. And a lot of the time they go, no, I didn't mean to do that. I was just had a bit of excess income above what I thought I'd put in. And so I was just putting it all in there and say, well, it's fine. Put in your 125% and you can start with a surplus. You can just start another investment bond.
Yeah.
I think that rule, it helps on multiple aspects. Like you've got obviously the dollar cost averaging, but I think it's great because it gives people a bit of discipline. So it's just set up, everything's all done. They don't really have to think about it. Money will go out and they'll know that at the time within the next 10 years or so forth, they'll have that capital there that's going to be there for the goals that they've set it up for.
The fact they can log in online, hack, log, check the investment options, change the investment options around. So there's a lot of sort of
see what you can contribute on the 125% we put on the system there through the portal. So no, it's a really, really good point because how guilty are we all when there's excess money in our bank account? We go shopping. So if you've got a direct debit in there going into an investment, it's kind of like money that's not yours. And I think that just set discipline is just great to have in place.
Trust me, Grant, if you've got 3 kids like me, that money evaporates very quickly.
I know. Where does it go? So I always say I'm doing the Australian haka. Where's my wallet? I'm sort of tapping my pockets everywhere.
Definitely paying yourself first is a good thing as well. And it sounds like too, I did have a little look at the website, and it seems very consumer friendly as well. But do you get a lot of clients investing through advisors as well as on their own, or how does that look?
Yeah, we have both. I have to say for our business, just over 90% come through financial advisors. And I think the reason that's the case is because it's not as mainstream. Like if you ask someone about superannuation and how the tax works, they couldn't answer it, but they know super and they've got super guarantees. And there's obviously a lot of media attention around that particular structure, where ours is not quite the same. There's no mandatory investment that has to go in there. So it doesn't attract that level of attention. So we do have a lot of our, flows come through the advisor channel, but also direct too. And it's funny, percentage-wise, it sounds small, only having sort of that 8 or 9% that flow through the direct channel that people sort of do it. But we actually have a lot of direct clients. They're just smaller amounts. So they might be like $5,000 or $10,000 where, you can get significant sums that come through the financial advice network and truly have an estate planning strategy, or these people are really wealthy and they're just paying too much tax and they can't put any money inside superannuation or don't want to anymore. So, we sort of see both ends of the spectrum. But yeah, we get a lot of direct clients. And purely, even sitting here and the things we're doing today, it's surprising the spike of people go, I should just direct, $1,000 minimum we have in there and then just keep adding to that investment. Yeah.
Well, that's the flexibility of it as well, because not only so it's a separate structure now, completely separate structure, loads of different investments. You don't have to be a bazillionaire to invest in it and get stuck into it and start investing, right?
Yeah. That's the nice thing about it. That's what I love about what we're doing, is the fact that you can just have a really small amount of money and you can just start investing. And it talks to before what we were saying around the disciplines of investing. And it's really important. I mean, we do a great job with super because we have super guarantees. It has to go in there and you can't touch it. So, the disciplines are legislated for you, where this structure, you can put a few things in place and you kind of a bit more set and forget. And you don't have to worry about the fees, or you don't have to worry about, doing your tax returns on this money or anything like that, because it's all done on your behalf.
Yeah. What I like is that you don't get the kind of blind side of all of a sudden I've got this tax liability that I didn't plan for and I had no control over. That really resonated with me a lot when you said that.
People don't understand the actual impact on that, because what can happen, and I hope I'm not going too technical here for people, but you can invest in, say, say, a managed fund, and these are fantastic products, don't get me wrong, but if that fund has been running for quite some time, there can be quite a substantial tax liability that's built up in there.
Exactly.
So you invest in January, then all of a sudden it comes to 30 June, even if you've had negative performance, so your unit price has gone, say, from $1 down to 95 cents, you can still receive a distribution from that fund that you didn't expect that you have to pay tax on. So you go, okay, I've dropped 5%, but I'm paying tax. These are things that don't happen inside our structure, and people are probably sitting there right now going, wow, does that really happen? And they're like, absolutely it does in the investment world. So your net performance, once you count your own personal tax liability, you could be down 5% on that fund, but you could be down another 2 or 3% even because you've paid tax as well on top of that.
See, I think we've had a lot of those cases. I think the last year, the year before, where their clients did have massive negative returns, but the distributions were so high, they're getting annoyed, going, "Why am I paying tax?"
Well, it adds insult to injury, and that's why we get a lot of calls at the beginning of June, going, "What happened? It can't happen again." And then it's really talking about structuring for the future and how you're investing, right?
Yeah, correct. And this is a really big thing, and particularly in markets that are volatile as well. Is that you can have negative investment performance, but still be paying tax, which inside our environment, we're obviously managing all that, and you don't get a distribution at the end of 30 June. You take distributions when you want to take distributions. And the ironic thing, it can be exactly the same fund, but be managed in our tax environment versus, one outside of it can have very, very different outcomes. And this is what we're actually trying to educate, really, even just in the financial advice network. We shouldn't so much be always looking at the headline return. Like I said before, that 10% or that 11% return can look fantastic. But what's your after-tax performance? Because there's a lot of noise from headline to after-tax, and you've got to make sure that you're maximizing your after-tax performance, because that's what you get to keep.
For me, that's the only important return. is the after-tax return.
That should be all that matter. But we don't talk about it in this country. And I actually was over in the US last year because they do a lot of this sort of stuff. I was talking to one of the largest fund managers in the world over there, and in the US they write to their customers 6 weeks out to saying, do you want a distribution this year or not? And if you've had a big tax year, of course you're not going to take the distribution.
No.
And their after-tax, I guess, maturity is so much further ahead. And I sort of went to my 2IC and to my executive team, I said, it is our job now to educate the Australian market on after-tax performance.
Absolutely.
So we can't let it be done for us. We've got to go out there and start talking about this, start, showing what the figures, state, and giving clarity to investors and financial advisors. So we start to mature a lot on this. We've just been so, I guess, I'm not going to use the word lazy because that sounds patronizing, but super has made us a bit lazy because it's been such an awesome structure, right? But the continual narrative around change inside super means we have to consider other alternatives to invest through.
Exactly.
Even if we're smaller investors, if we define ourselves like that. So then I kind of go, okay, if this is a changing structural thing in this country, we've got to make sure people understand the after-tax
But I think
side
it's
of
not
this.
just financial planners, Grant. I feel a lot of other financial professional or sort of related professional parties like your mortgage brokers and accountants, if they're not about strategy like that, and we work with a lot of mortgage brokers and accountants who would love this part of the strategy where they're sort of helping clients' kids out to build this great tax-free investment scheme, which allows them to sort of buy the things they want to do, or buy the properties, or buy the assets.
It's a big education piece, not only to the end consumer clients, but also to all the professionals, like you said, financial advisors, and to your point, brokers, accountants, because we do work a lot with those professions for the client's benefit.
Trust, right? Like you kind of go, I know super, I trust super.
Yes, that's what it is.
I know, how a company works. I trust that. I know how a trust works. These are all sort of very mainstream vehicles. But the investment bond, you go, well, how does that work? And it's like, well, it actually predates super in terms of its legal structure. So it's been around for a very, very long time, and it's been very, very stable. It's just not been as mainstream because, like I said, super has been probably too good for too long. And now the government's going, okay, this pool is huge now. It's been used for not what we anticipated. It's been fantastic for accumulating, wealth for retirement, and it's got to continue to do a fantastic job for this country and not have as many people rely on the full age pension as what they would have once upon a time, and given the fact that people are living longer as well. But now they're going, well, but we're not going to make it like a significant tax arbitrage for really wealthy people. And we don't want it to be an estate planning vehicle as well. This is not what we set it up for.
No, so there's tinkering around the edges as well.
Yeah.
Look, I'll tell you what we might do is have a little bit of a break now, and we will look at going into another episode. But thank you so much. So you have done a lot by coming on this podcast with us to actually fulfill that mandate and really spread the news about what actually an investment bond is. So thank you very much, Grant Hackett.
No, my pleasure. You can probably hear that I love talking about it, to be honest. I think it's fantastic.
Grant, I can tell. Stay tuned for the next episode. We're going to drill into a little bit more of the retirement planning with bonds, as well as estate planning as well. Thank you very much. Really enjoyed your company today.
Thank you.